Hello friends, welcome to the session on cost behavior and costing techniques. Let me introduce you to the topic. Friends, costing is very important for managerial decision making. A proper cost accounting is immense use to an organization. In taking managerial decisions, behavior of cost occupies a great place. The sensitivity of fixed costs, variable cost, semi-variable costs or mixed costs needs to be understood well by accountants and managers. We know that overheads can be classified as fixed overheads and variable overheads. Similarly, costs can also be classified as fixed costs and variable parts. It is not fair to apportion fixed cost to production, charging the cost against the amount arising out of excess of selling price over total variable costs. Friends, marginal costing technique is based on this concept. This session will talk on the concept of absorption costing and marginal costing. The session will also explain the meaning of the cost behavior and type of cost, the comparison of absorption costing and variable costing, and reconciling absorption costing. In this session, the concept of marginal costing, its special features, all its related factors are dealt with, and also the marginal costing technique, how it is used for essential decisions is explained. Now let me explain you the objectives of the session. The objectives of the session are to make you understand the cost behavior and types, to make you understand the concept of absorption costing and marginal costing, to differentiate between absorption and marginal costing, to make you understand benefits and shortcomings of absorption and marginal costing, and also to make you understand managerial applications of marginal costing. Let us start with cost behavior. Friends, cost behavior refers to the way different type of production cost change when there is a change in the level of production. Cost behavior refers to the sensitivity of cost to change in the production or sales volume. The range of output or sales over which cost behavior patterns remains unchanged is called the relevant range. Friends, cost behavior information allows managers to prepare budgets, to predict cash flows, to plan dividend payments, to establish selling prices. In fact, there are three main types of costs according to their behavior. First is fixed cost. Fixed costs are those which do not change with the level of activity within the relevant range. These costs will incur even if no units are produced. For example, rent expense, straight line depreciation expense, and so on. Let us understand this with the help of one example. If you look into this table, total fixed cost is 30,000 rupees and the units produced are different in all the three cases, that is 5,000, 10,000 and 15,000. And so, if you talk about fixed cost per unit, that comes to rupees 6, rupees 3 and rupees 2 respectively. From the table, if we plot a graph, we can see that total fixed cost remain fixed and stagnant irrespective of units produced. But fixed cost per unit decreases with increase in production. Now the second is variable cost. Friends, variable costs change in direct proportion to the level of production. This means that total variable cost increases when more units are produced and decreases when less units are produced. Although variable in total, these costs are constant per unit. For example, the table shows here the total variable cost, that is 10,000, 20,000 and 30,000, which varies with the units produced. The units produced, if you look into the figures, are 5,000, 10,000 and 15,000 respectively. And so, the variable cost per unit is rupees 2 in all the cases. If we plot the graph, from that we can see that total variable costs increase when more units are produced and decrease when less units are produced, while the variable cost per unit is stagnant irrespective of number of units produced. Third is semi-variable or mixed costs. Friends, mixed cost or semi-variable costs have properties of both fixed and variable costs due to presence of both variable and fixed components in them. An example of mixed cost is telephone expense, because it usually consists of a fixed component such as line rent and fixed subscription charges, as well as variable cost charged per minute cost. Another example of mixed cost is delivery cost, which has a fixed component of depreciation cost of trucks and a variable component of fuel expense. Friends, since mixed cost figures are not useful in their raw form, therefore, they are split into their fixed and variable components by using cost behavioral analysis techniques such as high-low method, scatter diagram method and regression analysis. Now, let us understand what is absorption costing. Absorption costing is a principle whereby fixed as well as variable costs are allocated to cost units and total overheads are absorbed according to activity level. According to CIMA, absorption costing is a principle whereby fixed as well as variable costs are allotted to cost units. Under this system, cost per unit includes fixed expense in addition to variable costs. Friends, the absorption costing is applied where production cost and cost of all the functions are allotted. Absorption costing aims at identifying all costs, both variable and fixed, to production. It is also referred as production costing. Accordingly, absorption costing allocates cost to finished product and inventories. This allocation has effect of carrying over the cost incurred in one period to the next period through inventories. Absorption costing is a principle whereby fixed as well as variable costs are allotted to cost units. Under this system, cost per unit includes fixed expenses in addition to variable cost. Now, let us understand what are the features of absorption costing. Friends, absorption costing aims at linking all costs to production. It allocates cost to finished products and inventories. In fact, fixed as well as variable costs are allotted to cost units and total overheads are absorbed according to the activity level. The proportionate allocation for the inventories passing through various stages of production process may be accurately made. Absorption costing may be designed as the job order or process cost for which the actual and standard cost are utilized. Friends, for variable cost, the proportionate allocation for the inventories passing through various stages of production may be accurately made. And any changes in the volume of stock carried from one period to another will affect the profit earned. All fixed costs are not charged to the profit and loss account of the period in which they incurred. Real problem in the allocation of fixed cost arises. Under the absorption cost, the costs are not segregated into variable and fixed categories. Absorption costing may also be designed as job order or process cost and may utilize actual or standard costs. Let us understand now limitations of absorption costing or total cost method. First is difficulty in comparison and control of cost. Friends, under absorption costing, different unit costs are obtained on different levels of output. If the level of output is increased, the unit cost is decreased and vice versa. This is due to inclusion of fixed costs. Hence, there is no possibility of comparison and control of cost. Second limitation is no use to managerial decisions. Friends, the top management people are very much interested to take a number of decisions like selection of suitable product mix, whether to buy a product or manufacture, whether to accept an export order or not, whether to fix the selling price below the total cost or not, number of units to be produced and sold to earn desired profit, and so on. The data provided by the absorption costing are not sufficient to take all mentioned different type of decisions. The third limitation is no control of fixed cost. Friends, the closing stock is valued at the cost of production, which includes fixed cost. The current year closing stock is the opening stock of next year. The closing stock will be sold in the years to come. If so, a portion of fixed cost is carried forward to the next year and hence there is no control over the fixed cost. Now, let us understand marginal costing. Marginal costing is a unique technique of costing in which only variable costs are accumulated and cost per unit is ascertained only on the basis of variable cost. For ascertaining the value of inventories, prime cost and variable overheads are taken into account. Generally, fixed costs are not controllable as they tend to vary with time rather than with level or type of output. Thus, fixed costs are not considered under the marginal costing. Marginal costing is defined as the accounting system in which variable costs are charged to cost units and fixed costs of the period are written off in full against the aggregate contribution. CIMA defined marginal costing as the principle whereby marginal cost of cost units are ascertained. Only variable costs are charged to cost units. The fixed costs attributable to a relevant period being written off in full against the contribution for that period. Let us look into features of marginal costing. Friends, here the costs are segregated into fixed and variable and semi-variable elements. Product costs are considered on the basis of variable cost only. The fixed costs incurred during a period are excluded from the product cost. They are treated as period cost and charged to the profit and loss account. Friends, marginal costing combines the techniques of cost recording and cost reporting. The unit cost of a product means the average variable cost of manufacturing the product, and only variable costs are taken into account for computing the value of stocks of work in process and finished products. They are valued at marginal cost of production. Also, profit is determined in terms of marginal contribution. Any change of stock carried from one period to another will not affect the profit earned. Now, let us see advantages of marginal costing. The first advantage is cost control. Friends, marginal costing makes it easier to determine and control cost of production. By avoiding the arbitrary allocation of fixed overhead cost, management can concentrate on achieving and maintaining a uniform and consistent marginal cost. Second is simplicity. Friends, marginal costing is simple to understand and operate, and it can be combined with other forms of costing like budgetary costing and standard costing without much difficulty. Third is elimination of cost variance per unit. Since fixed overheads are not charged to the cost of production in marginal costing, units have a standard cost. Next is short-term profit planning. Marginal costing can help in short-term profit planning and is easily demonstrated with break-even charts and profit graphs. Comparative profitability can be easily accessed and brought to the notice of the management for decision making. Another advantage is accurate overhead recovery rate. Friends, this method of costing eliminates large balances left in the overhead control accounts, which makes it easier to ascertain an accurate overhead recovery rate. Another advantage is maximum return to the business. With the help of marginal costing, the effect of alternative sales or production policies are most readily appreciated and assessed, ensuring that the decisions taken will yield the maximum return to the business. Now, let us understand the disadvantages of marginal costing. The first is classifying cost. Friends, it is very difficult to separate all cost into fixed and variable cost clearly, since all costs are variable in the long run. Hence, such classification sometimes may give misleading results. Furthermore, in a firm with many different kinds of products, marginal costing can prove less useful. Second is accurately representing profits. Since the closing stock consists only of variable costs and ignore fixed costs, which could be considerable, it gives a distorted picture of profits to the shareholders. Third disadvantage is semi-variable cost. Friends, semi-variable costs are either excluded or incorrectly analyzed, and that leads to distortions. Next is recovery of overheads. With marginal costing, there is often the problem of under or over recovery of overheads. Since variable costs are apportioned on an estimated basis and not on actual value. Another disadvantage is external reporting. Friends, marginal costing cannot be used in external reports, which must have a complete view of all indirect and overhead costs. Next is increasing cost. Since it is based on historical data, marginal costing can give an inaccurate picture in the presence of increasing costs or increasing production. Now, let me give you pro forma for calculation of profit under marginal and absorption costing. First of all, let us look into how to calculate profit under marginal costing. If you see this table, firstly, you need to write down the sales revenue. Out of sales revenue, you will have to deduct marginal cost of sales and opening stock, which is valued at marginal cost. After that, you need to add production cost, which is valued at a marginal cost, and that will give you total production cost, out of which again you will deduct closing stock, which is valued at a marginal cost. You will add marginal cost of production and selling, admin and distribution cost, out of which you will have to deduct total marginal cost of sales, and that will give you total contribution. Out of contribution, if you deduct fixed cost, that will give you total marginal costing profit. Now, let us see how to calculate profit under absorption costing. First of all, you have to take a figure of sales revenue. From that, you need to deduct absorption cost of sales and opening stock valued at absorption cost. Then you add production cost, which is valued at absorption cost, and that will give you total production cost. From total production cost, you deduct closing stock valued at absorption cost, and that will give you absorption cost of production. In absorption cost of production, you add selling, admin and distribution cost, which will give you absorption cost of sales. You also need to add unadjusted profit, and which will include fixed production overhead absorbed and fixed production overhead incurred. That will give you under or over absorption, and then in totality it will give you adjusted profit. This is all calculation related to profit under marginal costing and profit under absorption costing. Now, let us see difference between absorption and marginal costing. The given points will show the differences between the absorption costing and marginal costing. First is product costing. Friends, both fixed and variable cost are treated as product cost under absorption costing, but in case of marginal costing, only variable costs are treated as product costs. Second is inventory valuation. Under absorption costing, both fixed cost and variable cost are taken into consideration for valuation, but under marginal costing, variable cost alone are taken into consideration for valuation. Third point is profit concept. Friends, profit is the difference between sales revenue and total cost under absorption costing. the managerial decision making is based on this figure. But in case of marginal costing, the managerial decision making is based on the contribution. The term contribution refers to the excess of sales revenue over marginal cost. Fourth point is under or over absorption of overheads. Under absorption costing, fixed costs are treated as product cost. Hence, these are apportioned over the products arbitrarily, which leads to the problem of under or over absorption of overheads. But in the case of marginal costing, such problem is not raised since fixed costs are excluded from the purview of product costs. Fifth point is use of costing method. Marginal costing is often used in decision making process, while absorption costing is used for external reporting. Sixth is a segregation of cost. Friends, under absorption costing, costs are never classified into fixed and variable, but in marginal costing, cost must be classified into fixed and variable cost. Seventh point is a treatment of fixed production overheads. Fixed production overheads are included in the cost per unit. Stocks are valued at total cost in absorption costings, while in marginal costing, fixed production overheads are not included in the calculation of cost per units. Eighth is ascertainment of profit. In absorption costing, profit is ascertained by computing the difference between the sales and cost of goods sold, while in marginal costing, profit is ascertained by computing the contribution and then deducting the total fixed expenses. Ninth is apportionment of fixed cost and its effect. Friends, fixed costs are apportioned arbitrarily. Due to this, under and over absorption of overheads will result. Adjustments for recovery of such under and over absorptions have to be made. While in marginal costing, no arbitrary apportionment of fixed cost arise. No resulting of under and over absorption of overheads, and the question of adjustments of recovery does not arise in case of marginal costing. Now, let me summarize the session. Friends, costing is very important part of making management decisions. Cost behavior occupies great place as it determines the sensitivity of firm. It categorizes cost into fixed, variable and semi-variable. Friends, we have seen the meaning, features, advantages and disadvantages of absorption and marginal costing. Absorption costing and marginal costing can be helpful for short-term decision making. We have seen that marginal costing is a useful analysis tool which usually helps management make decisions and understand the answer to specific questions about revenue. That said, it is not a costing methodology for creating financial statements. In fact, accounting standards explicitly exclude marginal costing from financial statement reporting. Therefore, it does not fill the role of a standard costing, job costing or process costing system, all of which contribute actual changes in the accounting records. I hope the session has given you insight into the cost behavior